We said, if we were going to build an insurance company from scratch, how would we want it to be? And the resultant company was different by just about every measure. The business model is different, the distribution model is different, obviously the tech stack is different. And by rethinking those first principles and having the benefit of no legacy, it allows you to do stuff that incumbents, frankly, just aren't able to do.
Video, and in today's video, I wanted to talk about Lemonade and how much of a dip they took today. Just alone, they're down about 10%. So this is a stock that's been pretty popular ever since it IPO'd, and I just wanted to talk about the business and what I think about them. But before we get into it, if you guys don't mind just dropping a like and hitting subscribe, it really helps out the channel. Definitely check out the links in the description for the free Discord server and my referral links to Robinhood and Webull. When you sign up, you can get some free stocks. And make sure you're dropping a comment on the video to be entered into the shoe giveaway with Peak Sportswear when I hit 6,000 subscribers. So we're approaching that, just about 500 away. We're getting so close, and can't thank you guys enough for all the support. Now let's get into it. So keep in mind, this is a speculative play, and I've pretty much seen 50-50 split on bulls and bears. So this one is all depending on what kind of investor you are and if you're willing to take a little bit of risk on potential, growth in a company. So Lemonade is a US-based property and casualty company. They recently IPO'd a few months back and had huge IPO gains of around 140% despite the ongoing pandemic crisis. Lemonade's goal was to revolutionize the insurance industry from the initial interaction through to claims. The New York-based company plans to fundamentally challenge how the insurance business works by combining its technological expertise and social impact goals. So Lemonade's goal is to harness technology and social impact to be the world's most loved insurance company. Lemonade currently operates mainly in the US across 29 states, Germany, and the Netherlands. Lemonade offers renters and homeowners insurance in the US, while in Europe they offer content and liability insurance. So personally, I do think Lemonade is great, and in most instances, it offers much cheaper homeowners insurance. Not only that, it is quick, fully digitalized, and no hassle claims, and it takes an average of like 2 to 3 minutes to get insurance from Lemonade and file your claim. You file through a chat on their app or their site, and you don't have to talk to anyone or deal with like being put on hold or waiting, so I think that's pretty awesome. Lemonade is fully digital, and it leverages its technology, data, and artificial intelligence to underwrite its policy. It's fully customizable, quick, user-friendly, and available on the Lemonade app or your PC. So on the surface, there's no real difference between how Lemonade Insurance and traditional insurers make money. They make money primarily from underwriting and investment income. Here's how Lemonade differentiates itself. Firstly, its business model is based on behavioral economics, and they retain a fixed fee as a profit. This is currently around 25% of premiums. The remaining funds are first used to pay claims and expenses, and finally, the funds that are left over are donated to their common cause. Insurance companies and its customers have long been entangled in a love-hate relationship. In essence, it's a zero-sum game where the gain for the customer is essentially a loss for the insurer and vice versa. Consequently, the fixed fee element of its business model is designed to address this issue. Lemonade is really focused on its customers and being transparent, and this is intended to neutralize the conflict of interest between insurers and customers. Backed by evidence from behavioral economics, the introduction of a fixed fee component and its charitable initiatives are designed to maximize a customer's trust, reducing fraud and hence a win-win situation, or at least a better situation than a traditional insurance model. So a bit about their growth and the opportunity. We know that Lemonade offers renters and homeowners insurance in the US. In addition, it also offers contents and liability insurance in Germany and the Netherlands. Lemonade's exponential growth is evident. In Q1 of 2020, it delivered a NEP, and that's net earned premium, of greater than its whole 2018. As an emerging growth company, Lemonade's key drivers are simply just acquiring more customers. Lemonade's growth strategy has largely depended on social media advertising and word of mouth. I think their logo and the colors they use and the name of the company, is really catchy, and I think people are drawn to this naturally. Now with the stock listed, we can expect greater coverage and brand awareness, which will further drive top-line growth, growing its target market. Lemonade's customers' average age is around 25 to 30 years old, which is fairly young in the insurance world. For homeowners and renters insurance, these are usually the lower premium tickets just because they're not that expensive to get. As customers move up in the economic ladder, Lemonade can broaden its target market towards higher premium, wealthier, and older age groups. Lemonade can also launch new products, leveraging the firm's DNA, for example, pet insurance. Expanding to new geographies, Lemonade has tremendous potential in expanding geographically. In the US, Lemonade is currently only active in 29 states. Similar in Europe, it's only operating in Germany and the Netherlands. Lemonade has no presence in Asia, so it's fair to say that they have tons of room to expand and grow their business. Overall, their customers are increasing and they're retaining these customers, which is awesome for the company, and they're also making more off these claims. Now, I think they are disruptive, and people love technology. They love the simplicity of the app and how easy it is to file a claim. People want things done fast and easy, so it just makes sense to me. Their loss ratio is consistently coming down, which means that their AI technology is working and getting better. So this means that their loss to premiums earned is actually improving, which is great for the company. So as a new company, they're definitely going to have to face some challenges and threats ahead. Other insurance companies could copy this idea and their business model. However, I think by them being the first, they have the advantage and they already have great customer retention and an awesome layout on their website and app. It's easy to use, and I just think that they have the advantage at the moment. But Lemonade's business model is actually nothing new, and if others can mimic their tech, then my thought is, nothing really sets them apart. So ultimately, Lemonade will need to prove to the market that its underwriting capabilities, backed by its cutting-edge technology, is a unique edge that is hard to replicate. Secondly, for regulated financial companies, size does matter. In fact, the larger the better because insurance is a business of pooling risk, so a larger and more diversified company is able to underwrite risk more economically versus a young and less diversified company. So, while Lemonade has so far been able to provide the value proposition for its customers, one of the key headwinds as the company expands is economies of scale and seeing how they, handle these big disasters and claims that will likely come to them in the future. So we'll definitely have to be watching for all of that. So just a couple more concerns and negatives. Like most new growth companies, Lemonade is not profitable yet. And for some investors, this is just a huge turnoff and they won't even look at the stock. And that's totally fine and understandable. Everyone has a different approach to investing and a different risk tolerance. So for a speculative growth play like this, I would suggest scaling into the position if you're interested and not allocating a huge portion of your portfolio to this one stock, just to have proper risk management in case things did go sideways. With plays like this, the risk is higher, but the reward is also higher, if things turn out great in the future. Another negative is that ARK Invest doesn't really like Lemonade, and it kind of puts a bad taste in people's mouths. People who really look up to ARK and follow them to a T, they probably think, if ARK isn't buying, then maybe it's not a good buy, and maybe, there's no future potential here. I would say that the main reason that ARK isn't buying from the interview I saw is because of the low moat. But in my opinion, with these newer growth companies, low moat is very common, so I'm not sure that's like a fair evaluation of the company. So in conclusion, I personally like Lemonade as a long-term speculative growth play, and I am confident that Lemonade will continue to deliver strong top-line growth, and they have pretty strong retention rate with 90% of its customers saying they're not switching to another carrier. And clearly Lemonade is filling the gaps in the market that others are not willing to do. And I think they have a great app, they have a clean layout, it's fast to use, and it's easy to use. And I think that's just what people want. So, it seems pretty positive in my eyes. Now, this is one that's been on my watch list for quite some time, and I know a lot of people raved about this stock when it first came out, and even bought above, that $60 mark. And that was just basically hype and FOMO, and I always knew that it was overvalued at that price, and I knew it would eventually drop down. And as you see today, there was a huge pullback, creating a nice opportunity to get in. And I'm not saying to go buy in right away, because this is a speculative growth stock, but I think around, the $50 range or less is a pretty good area to consider buying in if you like the stock. So in my personal opinion, there are multiple plays here at this current price. If you're short, I do think that there's a swing trade opportunity here. I honestly believe that this will return to $60 plus in the near future. You would just have to hold it for a bit. And then long term, I could see this thing reaching higher highs in the coming months and even years, obviously. But a few things to be aware of is that they do have a lockup agreement, and that was 181 days from the S1 filing on June 6th. So I believe that management and existing institutional owners are allowed to sell around December 4th of 2020. So a sell-off could come, presenting another opportunity to buy in. Also, if they issued new shares, which I'm not sure when that would happen, but for new companies, it's pretty common. That could prevent share dilution, and that could also, create some selling and buying opportunities. So like I said, there's no rush to get into this. There's going to be multiple times to get in, but I do think it's currently at some pretty attractive prices with the sell-off today. And if it dips into the 40s, then I would really consider, buying into it. Definitely let me know what you guys think about this one. Please like and subscribe, and have a good one.
Ice, lemonade, my neck was tripping.